everybody. We're going to start now with the chapter. And what I'd like to do for those of you who are interested in reviewing this again, I am recording this right now, okay? So I'm going to record this lecture, and I'm also going to go through and record the problems we're going to go through, okay? So we'll just take our time. If you have questions, ask. I will try to make it really clear the specific items that we're going to cover in on the quiz, and I'll highlight them for you so you know what we're going to go over. This particular chapter deals with income taxes. How many of you guys have filed your returns yet? Anybody? Good for you. How many of you guys are now going to have to get an amended or an additional refund from the state of Minnesota because they're so goofy? Most states do that prior to the the year ending, and of course our lovely Minnesota has to struggle with it and then do it 3.5 months after the new year has started, which is very frustrating. The student loan interest is limited to $2,500, and depending on what your Minnesota tax rate is, if you have student loan interest of $2,500, and if you're in a 5% bracket, we're talking 100 some bucks. So it's not a lot of money, but hopefully they'll keep it the same. Everything helps, don't get me wrong, but it's not to the benefit the federal government is. You know, that's at 15 and 25%. But they should keep the tax laws the same another year. I haven't honestly looked into it. I just know what's being affected this year on that.
How do you know if, because I receive both of my returns, if I don't, would I know if something was funny?
Well, they'll refund it for you, they'll notify you, but there are certain aspects. It deals with, if you're a school teacher, there's a certain deduction. It deals with loan forgiveness on cancellation of debt, student loan interest, if you take an education tuition deduction instead of a credit. There's a couple items that really don't affect many people. If you have mortgage insurance premiums, then it does. But there are very few scenarios, but they can affect some people. But as we talk about income taxes and we start talking about corporate income taxes, there are things that's called the effective rate, and there is something called the statutory rate. I'm going to want you guys to know the difference between the effective rate and what the statutory rate is. The effective rate is basically you take your entire tax expense and you divide it by your income. So let's just say, you know how a lot of people will come and say, I'm getting taxed at a 30% rate. What does that really mean? Well, taxes are on a stair-step or progressive approach, okay? So from a standpoint of individual taxes, I don't have in my head the numbers for corporate taxes, but let's say taxable income. This is after your deductions, and you're a single person. From the first $9,000 of taxable income, roughly $9,000, gets taxed at a 10% interest or tax rate. And then taxable income from 9 to, let's just say, roughly 30-some thousand, 35,000, or let's say 38,000, that gets taxed at a 15% bracket. And then from roughly 38,000 up until maybe 89,000, that then gets taxed at a 25% rate, and it moves on up. This is like, in this case, your statutory tax rate. But the effective tax rate is at let's say when you go and file your return, you're paying $5,000 in taxes. But your taxable income is $40,000. Well, the effective rate is really the amount you owe in taxes divided by all your taxable income. The statutory rate is really the various levels set by the IRS based on the progressive rates. So you might be at a higher bracket, but not all your money's being taxed at that bracket. Make sense? So by averaging this out, the income tax expense divided by your financial tax income, it's going to definitely be an average of these numbers combined. Make sense? Know those two differences. What are accounting issues that are related to income taxes? 3 types of measurement and timing differences. Now we're going to talk about these 3 types. 1 relate to temporary differences, 1 are permanent differences, and then operating loss carrybacks and carry forwards. So if they say, if you get a question, what are the 3 types? Know those 3 types. Okay? Temporary differences are items of either revenue or expenses that might be in one fiscal period for accounting purposes and another period for income tax purposes. Because sometimes we may record income for book purposes in one period, but for tax purposes it may get recorded in another period. So those are temporary differences. Ultimately, income tax is going to occur. It's just a timing. Then you've got something, and the result of temporary tax differences result in either deferred tax assets or tax liabilities. You might prepay some taxes, so you've got a prepaid tax asset there, or you may have a tax liability or like a deferred liability of taxes you know you need to be paying. Another one relate to permanent differences. Items reported for financial accounting that never get reported for income. So there are maybe deductions for income taxes that really aren't expenses for financial accounting purposes. Permanent differences, you're never going to see it. There are different rules for either financial accounting or for tax purposes. Then we've got something called operating carrybacks and carry forwards. Operating losses allow you to sometimes carry back losses up to 5 years or 7 years, and then you get to carry them forward to offset future income. So, for example, I have a client that started a new business this year, and he's a C Corp, and he had like a $50,000 loss this year. So he's a C Corp, so the corporation pays the taxes, and those losses are going to get to be carried forward. So let's say next year he makes $20,000. He can offset this $50,000 in losses he had this year against his income. You see how it's a carry forward loss that he's going to get to use up? So these are carrybacks and carry forwards that ultimately affect income taxes, but they really don't affect financial accounting. When you have a $50,000 loss on your books, that period is over with. It gets put into retained earnings and you move on. Right? You guys know what I'm saying? Any questions on this? You guys good? Yes? No? Don't all start falling asleep because you got to eat. Okay. Temporary differences, permanent differences, and operating loss carrybacks and carry forwards. Would you be able to identify which is which? Okay? Thank you. Hey, Tony, will you send me these emails? You know what happens to me is I have 3 classes, and I'll tell a class, oh, I'll do this. And then I'm laying in bed going, which class was that for? So now I'm starting to ask people to email me, hey, managerial accounting, Nancy, you'd said you do this. Okay, Tony, you got to email me. Actually, let Hudson email me too. Okay, so causes of differences between financial reporting of income tax expense and then tax reporting of income taxes paid. So what we have here is financial reporting is all related to GAAP, generally accepted accounting principles. How many of us know GAAP? GAAP determines how we depreciate items. GAAP determines when we record revenues, when we record expenses. We know through GAAP how we need to record financial statement accounts. And we end up with an income, pre-tax income. From there, we'll calculate our income tax expense, and after that, we have net income after taxes. All of this is handled via GAAP. But then we've got this income tax recording. So revenues that are taxable, there might be revenues, but for tax purposes, we're only going to record taxable revenues, right? There are certain revenues that may be exempt from the IRS standards. So with the IRS, we're only recording taxable revenues per the Internal Revenue Code. Know what the IRC is? What's the IRC? Internal Revenue Code. And then we have certain tax deductions per the IRC. Here's an example. Let's say travel and entertainment, meals and entertainment. When you have a business, they probably deduct 100% of your meals and entertainment. You go and you take a client out on a golfing trip or take them to the Saints game. Oh, no, this is Vikings up here. The Vikings game. Once a New Orleans, always a New Orleans. Sorry, Vikings fans. But anyway, you write that off as an entertainment expense. Per the Internal Revenue Code, they don't allow you to write off 100% of entertainment and meals. They only allow 50%. Or let's just say with a company, they have company cars and they write off all the car scenario. Well, when it relates to businesses, they might only be able to write off a portion of those automobiles as it relates to business and then have to adjust, the books for another purpose. So there are guidelines that are related to taxes that are different from the GAAP. So in this scenario, know what the differences are. When we're dealing with revenues, these are going to be temporary differences. And if we're tax or timing differences, or they may be permanent differences when certain things just really are not ever going to be taxable or be deductible. Then we've got these operating loss carrybacks and carry forwards that can affect, for tax purposes, previous or future years. But that's not going to relate to GAAP, generally accepted accounting principles. Do you understand what I'm asking? Are there any questions so far? You guys good? So let's talk about a temporary difference. Measured difference between the tax basis of an asset or liability for income tax purposes and it's a reported amount, asset or liability on financial statement. So temporary difference, measured difference between the tax basis of an asset for income tax purposes and the reported amount on the financial statements. There can be timing differences, different time periods which affect pre-tax financial income and taxable income. So know that the tax basis may be different if you're dealing with the asset, and the asset might have a different basis, adjusted basis or basis from tax purposes to book purposes. Inter-period income tax allocation, allotting income tax obligations as an expense to various accounting periods. Inter-period. So ultimately the taxes are going to be paid. Which period are they going to be taxed in? Then we have something called deferred tax liability. When we know that future taxable income's going to be greater than future pre-tax financial income. So let's say we show some income on our books, but it's not being treated right now as taxable income. We may accrue a tax liability on our books because it's going to be taxed for IRS purposes in a future period. But that future period isn't going to have the financial statement or book income. That's going to be a lower amount. So in the period where we show it on the books, but it might not necessarily be taxed per the IRS, will accrue a liability taking into account the taxes for that income. Yes?
Is that kind of like if you have accounts receivable, or is it that you do have those funds and you just don't have?
It's like an accounts receivable where, again, for book purposes, we claim income not always when we receive it. We claim income when we've earned it, okay? But for tax purposes, it's a different scenario as to when we claim income. So when income is earned for book purposes, we're going to show that liability for taxes on that money, even though it might not be taxable income in that period. The taxable income might occur in a future period. Make sense? The obligation to pay is going to be greater in the future, so we're going to accrue that now on our books. A deferred tax asset is when future taxable income is going to be less than future pre-tax financial income. So the taxable income in the future is going to be a lot less than what our financial income is going to be. In that scenario, we're going to have a tax asset on our books to accrue for that money. So in other words, right now, for tax purposes, we've got greater taxes than we do the financial income, book income. So we're going to accrue an asset to accommodate the scenario where then down the road, as our future taxable income becomes less, we've got that asset to offset it with. Hang in there, we'll go through problems. Some of this is just theory, and then it makes more sense as we start applying it, okay? Temporary differences creating deferred tax liabilities. Here are some examples. Future taxable income is going to be greater than future pre-tax financial income. Revenues or gains are included in the pre-tax financial income prior to the time they're included in taxable income. Here are examples. Gross profit on installment sales normally are recognized at the point of sale for financial reporting purposes. However, for income tax purposes, it's normally recognized once the cash gets collected. Okay, do you know when we were talking about these installment sales in a couple chapters ago, how we were recording it as income when a certain portion of the sale occurred? Yet for income tax purposes, we're only going to record it when we get the cash. So in that case, future taxable income is going to be greater than what our book income shows right now. Gross profit on long-term construction contracts may be recognized for financial reporting purposes under the percentage of completion method, but for income tax purposes, it's going to be recorded only under the completed contract method. Investment income may be recognized under the equity method for financial purposes, but for income tax purposes, it's recognized when the dividends are received. You get the money, okay? And then again, unrealized holding gains on trading securities are recognized when they occur. But for income tax purposes, they're not recognized till they're realized, usually until it's happened. So do you see the differences of temporary differences of reporting income and the tax differences in periods? These are all ultimately going to happen. They affect different periods. Questions? Make sense? Expenses or losses are deducted to compute taxable income prior to the time they're subtracted to compute pre-tax financial income. So that means our taxable deductions happen before we put them on our books. When's that going to happen? Depreciable assets may be depreciated on an accelerated basis called MACRS, or Modified Accelerated Cost Recovery System. over a certain tax life that the IRS allows us to do based on the IRC. What's the IRC? Internal Revenue Code. But for financial reporting purposes, they might have to be depreciated over a different period using the straight line method. Here's a perfect example for you. An automobile. Automobiles generally can be recorded over a certain period of time, and they're for the most part accelerated over a period of is it 3 or 5 years? 5 years. Or is it 3 years? 5 years. And yet for financial statement purposes, an automobile is going to have to be straight line. Do you know what I'm talking about? Where it's the same amount over each year for the period of the automobile. So in tax accounting, there are times when you can take up to a certain amount and expense the whole asset in one period. So I have someone that purchases a $50,000 truck that's over 6,000 pounds. They can expense that entire $50,000 truck in 2013. But for tax financial statement purposes or book accounting, that truck is sitting on their books as an asset, right? And that truck needs to be depreciated straight line over its useful life, which can be 5 years or 7 years. Does that make sense? So for tax purposes, it got to be deducted in one period. But for financial statement purposes, it's going to not be depreciated that quickly. It's going to be depreciated a lot longer, over a longer period. Interest and taxes on certain self-construction projects may be deducted as incurred in arriving at taxable income. However, these costs may be capitalized in certain instances as part of the cost of the self-constructed asset for financial reporting. So let's just say there are certain assets that, buildings that are being built, that you're building. So a lot of times what can happen with tax accounting are they might allow a portion of that interest or taxes to be deducted. Whereas in book accounting or financial statement accounting, they make you capitalize or add that to the basis of the building. Do you know what I'm talking about? So when you finally compute the cost of the asset or the basis of the asset, it's going to include a lot of those costs. It's not going to be deducted as an expense. It's going to be capitalized or added to the asset. Questions? Am I making sense so far? Do I say that too much? It's my thing, but it almost gets annoying. So I apologize. I like to see that you guys are grasping what I'm saying. Next, prepaid expenses are deducted on the tax return in the period paid. But for financial reporting purposes, they're not recognized until the period used. What are we talking about? Supplies. Prepaid supplies that are sitting as an asset that we will deduct as we use them up. But what do we do with income tax purposes is when we spend $10,000 in supplies, we write off $10,000 of supplies. But for financial purposes, we show that as an asset, and then as we use them, we expense them. What about insurance? We pay a 3-year insurance policy. We write the whole thing off for tax purposes. But for book purposes, we expense that over the life of that insurance, okay, that we're paying the insurance for. So again, these are temporary differences due to deductions. Temporary differences creating deferred tax assets. Future taxable income is going to be less than future prepaid financial income. Revenues or gains are included in taxable income prior to the time they're included in financial income. So examples, items such as rent, interest, and royalties received in advance are taxable when they get received. However, they're not recognized as revenue for financial reporting purposes until the service actually has been provided. So let's say that you receive upfront rent for 3 years. For tax purposes, you receive that upfront rent, you're going to claim it as income. For financial statement purposes, we only show the rent as income when the time has passed and we've actually incurred that revenue. Okay, we've earned it. The time has passed on that. Gains on sales and leasebacks are taxed at the date of sale, but are reported over the life of the lease contract for financial reporting purposes. But again, usually for purposes of income taxes, when the event has happened and the money's exchanged hands is when it's going to be treated as taxable income. So these are situations where our taxable income now is greater than financial income in the future. Excuse me. Taxable income now is going to be greater today than it will be in the future, but our financial income today is less than what it's going to be in the future. Because as we receive it, if we receive a retainer, an attorney, we receive a retainer up front, we didn't earn that money, did we? And so that money really isn't going to be shown as earned until we do the work. But for income tax purposes, when we get that cash, we have to show it as income. Okay? Expenses or losses are subtracted to compute pre-tax financial income prior to the time they get deducted to compute taxable income. What are examples? Product warranty costs, bad debt expense, losses on inventories all get estimated. And they get recorded as expenses in the year for financial reporting purposes. But they're not going to be deducted until they are actually incurred to determine taxable income, when the warranty costs are paid or the bad debts are written off. So much of financial accounting is really trying to recognize revenues and recognize expenses in the period they are incurred. So a lot of times we create these estimates, allowance for doubtful accounts or allowance on warranty expenses, because we're trying to predict based on certain services or sales where we're going to have costs. We're trying to match them. But think with tax accounting, we don't care about matching. We record income when we get it. We record expenses when we pay them, okay? Or when the transaction occurs. So in this scenario, that's going to be a difference. The financial accounting are going to be a greater expense today. But for tax purposes, we're not going to show those expenses. But down the road, we might show a greater tax deduction, and it's going to affect our tax return at that time. Compensatory share option plans require the okay, basically, when certain employees are given for salary purposes options to have some shares of the company, when the employee actually does the work for the company, then those that income gets recorded, or that cost, or ultimately that salary gets recorded on, for financial purposes, the books. But for tax purposes, until that employee actually exercises those options and the event actually occurs, is when it's going to get recorded for tax purposes, okay, on a tax return. Indirect cost of producing inventory may be recorded as an expenses in the current year for financial recording purposes, but however, these costs may be capitalized in the cost of inventory and therefore deducted as part of cost of goods sold in a later year. Again, we've got, when we're dealing with managerial accounting, we've got all kinds of costs in there that make up cost of goods sold. And for financial reporting purposes, we may expense some of those items that for tax purposes we have to place into that cost of goods sold. Again, we're dealing with GAAP versus IRC, Internal Revenue Code. let's move on. If I don't talk about them in here, we're not going to see them on the test, okay? There's like a contingency I didn't even address, so ignore them. Do temporary differences create tax-related assets and liabilities? If so, do they require inter-period allocation? These are some things these are the issues we're facing when we're dealing with temporary tax issues. When do we, what tax rates are we going to use? The tax rates from this period, the tax rates that we're expecting. So we need to recognize the amount of income tax payable or refund for the current period. We should recognize deferred tax liabilities for future taxable amounts and deferred assets for future deductible amounts. Okay, so let's use comprehensive asset and liability approach when we're dealing with timing differences. Let's take a break here before we keep going on, and let's pause and take a problem. Okay? Is that okay, guys? So let's go to the book, and I'm going to find, let me see if I have this book in here. I'll just go to this book, Course Smart. Are you hot?
She's just giving me crap. The fan's been off the entire time and I used the outlet and now she's just giving me crap.
Oh, I'm just sitting here as cool as a cucumber with this little fan. Okay, guys, what page are we on for the exercise 18-1? Let me see here. $18.45, thanks. 18.1, let's just talk and go through some of these problems. For me, that's the way it cements in. I can hear a lot of theory, but it really means nothing until I start taking the detail. Future taxable amounts. Okay, so we've got here do I have my template up? So is this a problem I have for us?
Yeah.
Okay, so I want view. Okay, so Dern Company began operations at the beginning of 2013. At the end of 2013, Dern reported taxable income of $9,800 and pre-tax financial income of $11,200 because of a single temporary difference. So our taxable income was $9,800. Our pre-tax financial income is $11,200. Which one's higher? Financial income is higher than tax income, okay? The income tax rate for the current year is 30%, but Congress has enacted a 40% tax rate for 2014 and beyond. How are we going to prepare the income tax journal at the end of 2013? So we have actually shown more book income or financial income than we're showing taxable income. So we know next year we're going to have more taxable income than we're showing this year. So how are we going to do this, guys? Well, the income tax expense is going to be the difference between, let's see here, right now, income tax expense. Okay, let's figure out the other two before I get to that. The income taxes payable right now are $9,800, right? Let me show. $9,800. I'll make it this bigger for you guys. Can you see that now? 9,800 times, what's the tax rate right now? 30%. Or that's going to be $2,940, isn't it? What is the deferred tax liability for next year? How much are we deferring into next year? It's 11,200 minus the 9,800, which is what? What is that? 1,400 times what percent are we going to do now? 40%. And what is that going to be? How much is that amount? $560. So our income tax expense is going to be the combination right now of the $2,940 plus our $560, or $3,500. So we owe the amount that we are showing as income taxes in this period, but the amount that we know we're going to show as taxable income in the future period is going to be accrued at what we expect that tax rate to be. Any questions on this? How are you guys doing? Let's look at 18.2. At the end of 2013, Rowett Company reported a deferred tax liability of $6,120 based on an income tax rate excuse me, of 30%. So we have a deferred tax liability, which means there was income that was not taxed this year that we know is going to be taxed in a future period. On January 2nd of 2014, Congress changed the income tax rate to 35%. Now we need to calculate the amount of the adjustment to Rower's 2013 year-end deferred tax liability. So we need to figure out, what's this rate going to now be that we thought was at 30%, now it's at 35%? So I tried to make it easy on you instead of having to work every problem with me. Does that help? We can kind of go through some a little faster if you've got the answers there. So how are we going to figure this out? Our 6120 divided by 30% meant we intended on having $20,400 in future taxable income. Now, this $20,400 isn't going to get taxed at 30%, it's up at 35%. So now our number is going to be $7,140 of deferred tax liability, which means we've got to come up with the difference, the $7,140 minus the $6,120, or an extra $1,020. We need to increase our deferred tax liability. Does that make sense? Now the next question says, show how the deferred taxes would be reported.
Wait, that's the wrong.
Oh, thank you. Prepare the journal entry to correct Rowett's deferred tax liability. So how are we going to show the deferred tax liability? What's the new amount that we need to increase it by? 1,020. So we're going to show an income tax expense of 1,020 and a deferred tax liability of 1,020. Okay, we're going to adjust it. Okay, next. How you guys doing? Next. Temporary differences. At the end of 2013, its first year of operations, Slater Company reported a book value for its depreciable assets of $40,000 for financial reporting purposes and $33,000 for income tax purposes. Slater earned taxable income of $97,000 during 2013. The company is subject to a 30% income tax rate, and no change has been enacted for future years. The depreciation was the only temporary difference between the taxable income and pre-tax financial income. So what they're telling us is the depreciable assets from a book standpoint were $40,000, and for income tax purposes were $33,000. So we're showing basically $7,000 more in assets for financial reporting purposes than we are for tax purposes. And so this taxable income of $97,000 reflects that extra depreciation. Okay? So what we need to do is figure out, based on this accelerated depreciation that was good for income tax purposes but not for financial recording purposes, how are we going to show that entry? Okay? So the difference here on this is the $40,000 versus the $33,000. Okay, the $40,000 versus the $33,000 is basically $7,000, right? So the 40 minus the 33, and we're at what kind of tax rate? 30%? So for future tax purposes, we've got a deferred tax liability of $7,000 at 30% or $2,100 that we benefited from today because we took a greater deduction than we're going to be able to take in the future. Okay? We took the deduction today, but it creates a deferred liability for the future. And then as far as income taxes go, right now we're paying income taxes on $97,000, aren't we? So we're paying income taxes on $97,000 at 30%. Whoops. Which is a tax rate of how, or a tax amount of what? $29,100. And so our total income tax expense is $31,200. Make sense? So we took more depreciation for tax purposes than we took for financial purposes. And so as a result of that, we're going to have more taxes down the road. Okay? Any questions on this? Next, number 2. Show how the deferred taxes would be reported on Slater's December 31st, 2013 balance sheet. So we have this deferred tax. Where are we going to put it on the balance sheet, guys? Non-current liabilities. It is a liability, okay? We're going to treat it as a non-current liability. Why is it not current, guys? It's going to get paid off within 12 months? No, that's why it's non-current. Deferred tax liability of $2,100. How are you guys doing? Do you want a break? Yes? Okay, why don't we take a break for, how are y'all doing? 10 minutes? 20 minutes? 10 minutes?